When I first started out dividend investing around 6 or 7 years ago, there are a lot of things that I wish I would have known today. But in order to hopefully save you some time, some headaches, and hopefully some money, we're going to go through 5 important dividend stock mistakes to avoid when starting off in your dividend investing journey. So the first mistake that you should try to avoid at all costs is chasing high dividend yielding stocks. Now, when it comes to chasing high yields, many beginners make the mistake of focusing solely on the dividend yield and choosing stocks with the highest yield possible. However, the truth is a high yield can often indicate a risky or unsustainable dividend, and such companies may be facing financial difficulties, which is most likely why their dividend yield is so high in the first place. Now, I remember when I started investing, I would literally sort all the stocks and ETFs from highest yield to least highest yield. And that's because back then I didn't realize that there were things like dividend cuts. High dividend yields may indicate that the company is paying out a larger portion of its earnings as dividends. And some companies even take on debt to pay dividends to their shareholders. And while this might seem attractive to newer investors, it can also make dividends vulnerable to cuts if the company's earnings decrease or if the company faces financial difficulties ahead. And if I'm going to be honest with you, there's almost nothing worse than hearing that a company that you hold has officially cut their dividend. During the 2020 market crash, there were multiple companies throughout my portfolio that actually cut or suspended their dividend. A few of my larger holdings back in the day was Disney and AT&T, which both either cut or suspended their dividend. Dividend cuts can completely flip your portfolio upside down because you're relying on the dividend income to either buy you more shares and more stocks to grow your portfolio, or some of us are even using these dividends to pay our bills. So when choosing which dividend stocks to invest into, make sure you're not only purchasing these stocks because they are high yielding dividend stocks. The next mistake that I wish I could have avoided early on was ignoring the company's fundamentals. Now, before investing into any dividend stock, it's important to research the company's fundamentals. Now, these fundamentals could be things such as revenue growth, such as earnings, cash flow, debt levels, and management. Investing in a company with weak fundamentals can lead to poor long-term returns, and this is even if the dividend yield is very high. Now, understanding a company's fundamentals can help investors assess its current financial strength and predict its future growth potential. Now, obviously, anything can happen in the future, but investors can receive some very basic clues by looking back in time, maybe the last 5 years, and see how a company's revenue has grown possibly. See how a company's debt levels have either increased or decreased. Simple fundamental things like that. Additionally to that, talking about fundamentals, analyzing a company's fundamentals can help investors compare it to other competitors and can identify opportunities for an investment possibility. So maybe you're on the fence about investing into a certain stock. Well, match it up next to some of its competitors. And by looking at the fundamentals, you should easily be able to see which would be a better investment. The next mistake I made early on that I wish I would have understood is failing to diversify. Now, investing all your money into a few high-yielding dividend stocks can be very risky. It's important to diversify your portfolio across multiple sectors and industries to reduce risk and improve long-term returns. Now, when it comes to diversification, I wish I would have realized that there's really high-quality ETFs out there with very impressive long-term dividend growth and share price growth, something like SCHD. But instead of investing into something like that early on, I was just chasing high yielders and loading the boat on them. Things like AT&T and other riskier, higher yielding dividend stocks was what I had in my portfolio. So make sure early on that you're diversifying. And by doing some basic research that I didn't do at the start, you could easily realize that there's a lot of high quality ETFs out there that do pay nice sized dividends that are very well diversified. The next mistake I made early on that I wish I would have considered is understanding the payout ratio. Now, a dividend stock's payout ratio measures the percentage of earnings that a company pays out as dividends. A high payout ratio may indicate that the company is paying out more than it can afford to pay, which could lead to a dividend cut, which I have definitely seen in my past. It's important to consider the payout ratio when evaluating dividend stocks. So it's important to note that also different stocks, different industries are going to have a different payout ratio that's considered safe. Something like a REIT is going to have a different payout ratio that's considered safe compared to something like a consumer brand. Payout ratio is definitely one simple metric to pay attention to and to consider when building your dividend stock portfolio. Now, the last mistake I made when I started dividend investing is focusing solely on past performance. Now, past performance is not a guarantee of future performance. And just because a company like AT&T, for example, had a long history of paying dividends, it doesn't mean that it's going to continue to do so in the future. Now, for me personally, I like looking at a stock's previous historical performance. I think that's definitely an important metric, but it's 100% a good idea to not base the future performance off the prior performance. You have to really take everything with a grain of salt and realize things like just because a company has been paying a dividend for a long time, it doesn't mean that it's necessarily going to continue to do so. You need to look at everything encompassed and make sure to limit the mistakes you make when starting out. Now, all in all, when it comes to the journey of investing, especially dividend investing, the amount of experience and knowledge that you're going to retain is going to take time, and that's perfectly okay. But understanding things like dividend, stock selection, market trends lays some of the groundwork, and honestly, in my opinion, I think that the more research you do, even the more books you read, overall, the more education you have within your brain before you start putting your hard-earned money, possibly in harm's way, is a crucial decision that you're going to have to make. But all in all, the first most crucial lesson when it comes to dividend investing is to be open to continuous learning. And this is because markets evolve, economies fluctuate, companies adapt, and things are going to keep on changing as the years go on. Now, with this, patience is another vital trait. Early setbacks and mistakes are going to be inevitable, especially until you have the groundwork laid. But persisting through some of these earlier challenges and staying patient amid market swings are integral parts of the learning curve. And even though missteps and mistakes can be painful, they're going to provide insights for you later on. And considering dividend investing is going to be a lifelong journey for some of you at least it is for me, it's perfectly fine to come off the rails as long as you know how to get back on. Overtime experiences are going to solidify your investment philosophy. Consistency in applying your strategy is going to also build confidence. And regular dividends or long-term growth become affirmations of your approach. Now, let me know down below in the comments if you personally are what we would consider a newer dividend investor. Say maybe you've only been investing in dividend-paying stocks or ETFs for under a year. And also in the comments, let me know if you've been investing for a little bit longer. The last thing I'm going to say is this one final piece of advice from a dividend growth investor like myself that has been in this journey now for around 7 years and now has over 7 figures invested across the board. Make sure to please take your time and know to be successful in this journey, you are going to have to be patient. But with all that being said, best of luck, and I hope some of these things we went over in today's video are going to possibly help you within your journey. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.